I'd like is it on? Great. I'm Carol Wayman. I'm the Legislative Director for Congressman Keith Ellison. I just want to invite everybody here to a briefing on our SBA Franchise Loan Transparency Act of 2015, H.R. 3559. This bill's been introduced twice. The first one, we had one technical correction that we reintroduced, so if you do a search, you'll see 3195 and 3559. The one that we're working on is the 3559, and it was just to clarify that we wanted more average of all instead of just average of each unit. There was just a typo with Legislative Counsel, which I'm sure you're all familiar with, sometimes happens. I'm going to pass around a sign-up sheet, so if you'd be as kind to sign that, and then just turn it over to our speakers, who are members of the Coalition of Franchisee Associations, Keith Miller in the middle, Bob Spada, and Roy Ewers, to talk about franchise issues and the bill.
So thank you, Carol, and welcome this morning, and thank you for attending. My name's Keith Miller. I'm the chairman of the Coalition of Franchisee Associations. We are a trade organization representing franchisees only, and only franchisees. We're the largest franchisee organization in the country. We have 17 or 18 members now, I can't even keep track of it, of different associations, including Subway, which I'm actually a Subway franchisee. So as Carol knows, when she calls me, I'm usually making sandwiches on the West Coast and not wearing a suit and doing things like this. We also have Burger King and Dunkin' Donuts, 7-Eleven as members, and the AHOA, the Asian American Hotel Owners Association, is actually our biggest member. Our association really has a couple goals in supporting this bill, and that is first to protect future franchisees from getting in a situation through lack of disclosure and transparency. They become a victim of this process, and also really to make more money available for SBA lending to viable brands. We are big proponents of SBA lending and feel that SBA lending is good for the industry, but that doesn't mean it should go on, in a sense, unfettered and not have some control over it and disclosure. So we feel that passing this bill will actually make more money available to viable brands at lower rates and fees, because as we know, the SBA 7A program is, in a sense, self-funding through their fees and rates to keep the system going. If you knock out the worst 25%, for example, that would actually lower the rates to the good brands. We also continue as an association to seek more required disclosure and transparency, because we feel that prospective franchisees should have this information as part of their due diligence. We shouldn't make due diligence difficult. You'll hear stories today showing how the SBA loan guarantees have really created an environment of profit for different organizations, taken at the expense of new franchisees. We're supporting this bill because we believe these easy steps will stop the worst offenders. In our packet that you got on your chairs, the right side contains kind of a statement of why the CFA supports the bill. It talks about an overview of what the CFA is, and of course there's a copy of the bill. On the left side is kind of the information, the guts of why this bill is needed. The first part of it is a GAO study that was completed in 2013 that showed on 7A loans to franchises over the previous 10-year period, 28% of those loans required a government guarantee payment to the bank. Default rates are actually much higher than that. To get a guarantee payment to be initiated, you basically have to wipe out the person who took out the loan, homeless. These people become homeless, no assets. Their assets have to be cleared out. And so really the 28% number is even somewhat deceiving, because in previous trips to Capitol Hill, I've brought people who lost everything because of the problems in the process, yet aren't one of those numbers because they had a house that covered the guarantee portion of the loan. So they ended up homeless, but yet there was no guarantee payment required. Of those loans, there was $10.6 billion loaned out over that 10 years, 1.5 billion paid out, which is about 14%. So, you start doing the math of what it would require to collect in fees to keep that self-sufficient, and you're looking at an environment where a lot of good loans or safe loans, like in the lodging industry, are actually having to subsidize the problems. Also in the GAO report is highlighted where the GAO pointed out that first-year revenues are required for a franchisee to submit an application, yet they're very difficult to attain. And yet every franchise company, trust me, knows to a penny what first-year revenues are, because in general, first-year revenues are how they collect royalties. So they're pretty good at knowing what those are. Next are the first 2 pages of default rates by different brand published by the SBA. Now you'll notice it's a few years old. After we started digging into this subject, the SBA took the step of no longer releasing that data by franchise brand. So we can no longer get that data. But you see some fairly large ones, names that you know about, the Quiznos or whatever, who had almost 2,000 loans and a 50% default rates on loans, yet they were still getting SBA loans. And finally, there's a presentation that was given to the ABA Forum on Franchising. What's in there is just I put the cover page and a couple of the middle pages where it talked about disclosure. In that on disclosure, you will notice that it talks about franchisors aren't required to disclose information in item 19. That's where the FTC document where they would disclose this information. So you have disclosure not required. However, it encourages the franchise companies and the lenders to talk amongst themselves about the financial data to get a prospective franchisee qualified. However, it states that before you do that, you should get a non-disclosure and confidentiality agreement so the bank does not get any of the, serve as a conduit to get any of that information to the prospective franchisee. So when you think about it, you have 2 people who are going to profit from this loan, both the bank and the franchise company, talking about numbers behind the back of the prospective franchisee, and that information that they're filling out these applications with not being disclosed to the franchisee. I don't think you can find any other loan process where the person who signs on the dotted line and is ultimately liable for that loan with everything is not involved. So I'm going to turn it over to 2 individuals who have had, in a sense, their financial lives ruined through this process, and address how this bill, again, as a simple bill, will address most of the problems and actually would have solved their problems. Again, we could write a 200-page bill to try to get every little intricacy solved in this, but really a bill that asks for very little will solve 90-something% of the problems that we see. And they can basically show how it happened, how it impacted their lives, the cumulative effect it has on the economy, because when an individual files bankruptcy, there's money being written off to other banks, whether on their houses or credit cards, and how the actual impact of the number is much larger than the actual SBA loan guarantee. So I'm going to start with turning it over to Roy Ewers to my left, who he actually, it was before redistricting, was in Congressman Connolly's district, and Representative Connolly actually wrote a letter to the SBA, which I don't believe was ever satisfactorily answered on that. So Roy, go ahead and tell your story.
Okay. Thank you, Keith. Yes, as Keith mentions, Congressman Connolly did write 2 letters, one to the SBA, and an investigation was open, and one to the OCC, the Office of Controller of the Currency. Both of them began their investigations, and currently all these investigations are still ongoing over the number of years. As Keith said, I've lost everything. We lost not only our house, we lost all of our assets, 401k, retirement plan, about every dollar and dime we had. And it followed a process that is ongoing that this act, that I believe that this bill addresses specifically. This bill calls out things like the pro formas. It says the SBA requires pro forma projections, including projected revenue for the first year of operation of the franchise, as part of a standard operating requirement for franchisees to qualify for financing. In my case, the first pro forma that was produced by the lender and the franchisor working together showed a $186,000 first-year loss. Of course, that could not get an SBA qualified loan. They did subsequent pro formas. I only saw 2 of these pro formas. The last pro forma I saw was for a $170,000 profit the first year. That one was rejected. But what is important, there were multiple pro formas created and submitted that went from the $186,000 loss to a $198,000 profit, with numbers just being changed in the middle. And I did not see these final financials, but that represents a swing of $384,000. So $384,000 from what their numbers were at first to what their numbers were at the end. I brought a court case in the discovery data that the lender and the franchisor had to produce. None of their data matched. The pro forma that the lender sent to the SBA and the pro forma that the franchisor showed me, which was never signed by me, were completely different. An odd thing about it, it came out that the data that actually went to the SBA was even different than what the lender brought into the court case. So right away, without any real due diligence on anyone's part on examining what these lenders are sending and what these franchisors working inclusion are doing, is a big hole. This bill addresses that. It comes out there and says it must. The financials that were submitted from the SBA, where it says that the report specifically stated potential franchisees should include first-year revenue estimates in their SBA loan applications. What happened in my case is they could not get the loan through. I thought there was no way that I can go forward to this. And then in the court documents, it was found that what they had done is taken financial data from other stores that were successful, manipulated that data into the financials which they gave the SBA. So the first year revenue estimates, since there was no control on it, they make these robust presentations to the SBA and says these are concrete. And as also the bill addresses, the hidden discussions between the franchisor and the lender on financial data is critical to the loan process. In our court case, I have over 100 emails. There were emails going back and forth between the franchisor and the lender. And in these emails, you will see where the lender says, no, the number needs to be here or above. And then the franchisor would manipulate the numbers. Sometimes they would call me and say, we'll hold off on doing all of the renovation, and that'll improve the number. I was arguing the numbers all the way through this thing. Within the first 6 months, I could see that the numbers were not going to hit. But these hidden discussions went on without me knowing, so that when the final package that went to the SBA went, I never saw it. As a matter of fact, I got a call saying, hey, your loan is approved. And I said, based on what? The last information I had, the last pro forma I had been rejected by the SBA. Oh, they said, we worked it with the SBA. We worked a little bit with the franchisor. They're going to not do some of the renovation things, and they're going to put some money up into it. I said, fine, let me see it. They gave me this plan, which they never did. They never came up with the money, but they got the SBA loan with it. When they do these SBA loans, they're supposed to also, as the bill says, show the success rate. In my case, the company, the franchisor I had a program that they wanted my business to start off with called Vision 21. They said no store had ever failed if it had adapted this Vision 21 business plan and business model. Now, I'm very used to business models. I worked for Visa for 27 years. I was director of merchant services, and I know business models from mom and pops to the Walmarts. When we went and actually investigated this Vision 21 process, and the franchisor had to eventually admit to it because 2 class action lawsuits were brought out, one in southern Florida and one in the Eastern District of Illinois, that over 40% of the stores that had adopted this Vision 21 business model plan had failed. They had either gone bankrupt or out of business. This is another reason why this bill, which addresses this, needs to be passed. There are multiple different things in my case that happened. The lender, when the OCC investigation started, called me, and I have the emails. These were presented also. I have over 1,000 pages of everything that went back and forth. The lender asked me for my settlement paperwork because when the OCC went and opened and looked at the loan documentation, papers were missing. There was also a discrepancy of $130,000 that the lender could not account for. They wanted my settlement documentation. Of course, my legal team said, no, go to the settlement attorney. We sat down with the settlement attorney, and they did all they're the third party, they did it all. Why are you coming to us? It shows, again, that the lenders, the oversight that the lenders have obviously is not there. There's no real requirement once they get these loans pushed through with falsified financial data. There is nobody going back, nobody checking, and the SBA is only taking from an SBA lender the information as honest, straight through. And if we can get the transparency, if we can enforce the fact that the financials have to be upfront, and as Keith said, these franchises, they know what it costs to start one of their franchises. They know what a building costs. They know what your cost per square foot's going to be. They know how much inventory you brought in, how you have to price, what your margins need to be. There's no guesswork in it. But at the end of the day, what happens is when the business goes out like mine, the lender just turns to the SBA. They say, I get a guarantee of $1.3 million. They get their money, they go away. The franchisor, he's all covered with his franchise fees and requirements that he has. They walk away, they're whole. I am now stuck with no money, and this is how it trickles down. Not only do a $10,000 business loan that I had gotten through one bank, I had $15,000 from credit unions, so now these banks have lost during my personal and business bankruptcy this money.
Well, how much was your SBA guarantee payment?
My SBA guarantee payment was $1.3 million. The and credit cards, business credit cards that had to be paid off, another $15,000, and then $200,000 second mortgage. There's $240,000 just coming on my side. Now let's look at my vendors. There were over $260,000, maybe even closer to $270,000 of small business vendors, because I had a 25,000 square foot store, that these vendors didn't get paid. The money was taken by the lending institution, and now I have got vendors who supplied snow shovels, fertilizers, paint, everything. It was a hardware store, every possible thing there, that all of a sudden have payments due to them that due to the bankruptcy they never get. And that's damages them down the road because they have to eat that cost. They can't get it because in the bankruptcy, all the material, all the inventory in the store was auctioned off by the lender. And therefore it trickles down. Then you have your landlord. Landlord doesn't get the last 6 months of the rent. It's $50,000 a month. And then you think of the power and the utilities that could not be paid. And this all trickles down. This bill, if this bill passes, the key pieces that I've mentioned in these bills would have gone a long way to preventing my store from failing. It could have gone a long way to even preventing the loan from being approved. I wouldn't have even been in this situation. But by inflating, falsifying financial data and giving it to the federal government, to the SBA, in my opinion, is technically frauding a federal loan program. And these lenders are not being held accountable, and neither are these franchisors. I have thank you all for allowing me to get my story out to you. If anybody has questions at the end of this, I can tell you tons more, and tons more about the case in Chicago. And I thank you again for your time.
Thanks, Roy, and before I turn it over to Bob, we had one person who couldn't join us today who was involved with a concept called coffee beanery. And what's interesting about it was that there ended up being some lawsuits out of it. She was the example I gave, actually, who had a house that covered the loan, so the guarantee payment never happened in that case. However, coffee beanery, the bank actually changed the pro forma numbers and submitted it to the SBA, that she never saw what those were. So people, they feel so comfortable that they're gonna get their money that they'll just make up numbers because they know they're protected by the loan guarantee. Coffee beanery was interesting because in the trial it came out that the CEO, the executive team, when they would meet, so the CEO, CFO, COO all meeting, would testify that they had over 100 units, yet they knew only one of them was profitable. One out of over 100. They knew a couple were break even, and they knew everybody else was losing money. But they were still selling new coffee beaneries because they knew they could still qualify for an SBA loan, working with the lender who would obviously change the numbers. In the court case, the judges actually said, well, it was the SBA that was defrauded, not you, by this process, so go have the SBA sue the bank. You don't have any standing against the bank. But she was unable to make it today due to a death in the family. And but it's just unbelievable that we as taxpayers, and I use it as we as taxpayers because this is a very bipartisan issue to me. I don't know where it should split on political lines, but as taxpayers, I mean, we never think the federal government should be out there guaranteeing, in a sense, our loans with our money based on fraudulent information. Unfortunately, it's never fraudulent to the people providing the information because they're not the ones signing the loan application. It's the franchisee. So with that, I'm going to turn it over to Bob Spada and his story.
Thank you all for coming today. I received a phone call last night and I was told that many of you like to leave by 5 o'clock, so I was to shorten my conversation.
That was William. who
Yeah, I
said
know,
that.
that's the reason why. I started looking into franchising in 2006. I wanted to help children, see if there was something that I could do, and there was a reason for it. Primarily, my wife was ill, we had to move to a different area, and what I did was not done in the new area. I found HLC, Huntington Learning Center, and I called them up and started a discussion with them, and first thing that they do is they ask you a number of questions regarding your financial status. So they start digging in and find out whether or not you qualify, essentially, to purchase the franchise, whether or not you have enough assets. And they determined I did. I had about $300,000 to $400,000 in home equity on my house. So obviously, I was a great candidate. Didn't have a lot of liquid assets, but at that point, they determined I would be able to qualify for an SBA loan. So we entered into those discussions a bit, and while we were doing that, I had asked them what was the viability of their system. And they said that the SBA wouldn't give loans out to their company if there were any problems. Actually, from what I understand now, they really are not allowed to say that legally. But they did, and knowing at this point, I'm sure that I had no idea what the SBA rules and regulations were. They also had recommended a loan consultant. They said they'd be able to set me up with someone should I move further. I had asked for information on cash flow and profitability. Again, I had explained to them about my wife's stage 4 cancer and that I couldn't have something that required a lot of additional cash up front, and that I needed something that could not sustain that much in losses. I needed a proven, successful business model, and that's what I thought I was buying with the franchise. So eventually they said, look, yes, franchisees, they make on average first year about $75,000. So at which point I started my due diligence. I hired an attorney, I hired an accountant, make sure everyone was going over at that point it was called the UFOC, it's now called the FDD, Franchise Disclosure Document. I had called current Zs, I had called former Zs, and I actually visited several sites as well. And little did I know that the contract that everyone signs stipulates that you cannot disparage the mark. In other words, you cannot speak ill of the franchisor. If you do, it's grounds potentially for dismissal. Actually have your franchise taken away from you. If you have a loan against it, you keep the loan, you still have to pay off the loan. The franchise is taken from you with no remuneration whatsoever. So no one was sitting there saying anything bad about Huntington. I had also spoken to them about the numbers that I was provided, about the income, and no one refuted those numbers either. I had signed on at that point after my attorney said everything was pretty much a standard contract that the franchisors give. And the accountant couldn't find anything wrong with what was in the FDD. And obviously, you'll eventually learn that the accounting for franchising is a little bit different. Seeing what the franchisor is doing versus what the franchisee is doing is two completely different things. So they sent me to this loan consultant. I was told that they had done a number of Huntington Learning Center loans. Actually, they did the predominant number of them, and that she pretty much knew the system inside and out. They walked me through the numbers. Those numbers coincided with the numbers that the franchisor gave me, which again was not refuted by any of the franchisees. It seemed that everything was fine. So I started training. I went through 5 weeks. And there's a reason for, by the way, me going through the process here, but we had 5 weeks of training. Many of us signed on for the same week. So I had become very, very friendly with a lot of these franchisees. In the ensuing months, I found, as I continued to call them up, that none of them were making money. So I came in with a class of around 15 people. No one was profitable at all. In fact, everybody was losing money, including myself. And I realized at this point that there was a major problem. How could you have, I could understand a few people not making it. I could understand even maybe half of the people at the beginning not generating, but no one was generating a profit at this point. So when I started to talk to Huntington, I was told that I was the only one experiencing this problem. They didn't realize that I was talking to the other franchisees at this point. So at this point, I started to dig a lot deeper. I went into the FDD, I went into the contract, I went into my business plan, and I read and reread and reread, trying to see if there were any nuances in there that could get us out of this situation. People were telling me it was the marketing. People were telling me, no, it's it's the lack of help that we're getting from the franchisor. And I realized it had to be something else because we were all sucked in prior to us experiencing the marketing. And the reason for this part of the story is it took a conversation that I had had with this one particular franchisee every Saturday. He and I became very friendly. We spoke every Saturday afternoon. And in this one conversation, he said to me, you know what really ticks me off, Bob, is that I never came close to my first year $500,000 projection. Now, mind you, this was about 18 months, maybe 2 years actually, after I had already signed on. And it hit me like a ton of bricks, because as I said, I was going over all of the documentation. And the second he said, I said, do me a favor, give me a few minutes, I want to call you back. I go run into the house, I pull up my own business plan, and sure enough, I'm looking at it, I'm saying, here's $523,000 as my first year gross revenue projection. So I called him up, I said, do me a favor, send me the business plan. He sent it to me. It's got $501,000. Well, we're on completely different ends of the country with completely different demographics. How are we this close with our numbers? Granted, it wasn't exact. My rent is a little different than his. My insurance numbers are a little different than his, but we were very close. So I called another buddy down in Florida, and I said, send me your business plan, $503,000. I started calling a bunch of other people. Everyone was between $501,000 and $523,000. It was uncanny. Different areas of the country, different demographics. We all pretty much followed the same thing. We were also all sent to loan consultants, almost every single one of us, the same exact loan consultant. The reason why I tell you this is because at that point I realized there was a problem. If we're all given this number, the question then became, well, why were we given the number? So I looked into the SBA protocols, the standard operating procedures, myself and my accountant, and as we started to dig deeper, we realized that the SBA requires a certain profitability within your first year on your pro forma in order to obtain the loan. But it's not just any profitability, it has to meet a certain debt coverage ratio. So in other words, you couldn't just show a $10,000 net profit on a $300,000 loan, especially given what the current interest rates were. We all had to show around $75,000, lo and behold, the $75,000 number that I mentioned to you before, in order to meet the debt coverage ratio that the SBA required in order to obtain the loan. So at this point, I'm saying, okay, if we've got $500,000 as our numbers, we were all given the same numbers, we all realized why we were given the same numbers in terms of getting the SBA loan. The question now became, what were the real numbers? Turns out Huntington Learning Center stupidly printed in one of their newsletters about 18 months after I had signed on that in 2006, a brand new first-year center site's average was $249,000, half of the numbers that we were given. In 2007, the first-year brand new center average was $262,000. Now, we're talking 2 boom years, by the way, in the economy. We're not talking 2008. We're talking 2 years where in 06 and 07, where the economy was really heating up, and yet you had a $249,000 in 1 year, $262,000, yet we're all given $500,000 as our numbers. I went to the SBA Inspector General's office, and I called them up. And I spoke with a gentleman named Dan O'Rourke, who at that point was, and I think he may still be, I'm not sure, the Assistant Inspector General for Investigations. I went through the whole story with him, and he said, you know what? I want you to do me a favor. I want you to talk to my right-hand man, Aaron Collins, who looks at the East Coast numbers. And I promise you this will be over pretty quickly, but I just wanted to let you understand